keep the delicate economic balance of options overboard. While pain is inevitable, suffering is optional. It is common knowledge that any administration that came after the Buhari administration needed to make necessary and carefully thought out painful adjustments. And this burden of responsibility must come with both the right signaling, sequencing, and communication of the lag between action and when results manifest to moderate the suffering. The Bola Ahmed Tinubu administration courageously introduced policies that should have been adopted and implemented earlier under an appropriate policy sequencing program. Unfortunately, the administration decided on the right policies under the wrong sequencing arrangement, leading to an accelerated downturn in the disposable income of citizens. Truth be told, inflation and devaluation were not a cause, but a consequence of excessively loose monetary conditions, absence of fiscal direction, and panic-induced and uncoordinated responses from public leadership, from the presidency to the legislature and government at the state level. The macroeconomic and microeconomic indicators appear headed southwards at a rare, unprecedented, and unusual speed, causing panic, uncertainty, and finger-pointing. Nigerian households now make daily hard personal and financial decisions due to the choices that are now upon us, and policies we cannot deny or pretend about in our corners anymore. The people are understandably ill-prepared for the consequences. The key concern, however, must be the signal that the government may be equally ill-prepared for the meltdown and the remedial actions needed. At a time when bold and well-coordinated responses and communications are needed, current policy reactions appear to tilt towards a command-model economy, which is inconsistent with our free market economic model. The historical opaqueness in government finances and the absence of transparency and accountability have opened the doors for all manner of strategies, speculative actors, and survival advocates to metastasize. The trust deficit between citizens and the state's traditional institutions is widening, and we need to restore confidence in the economy, the currency, the financial markets, and the productive entities in the country. However, if citizens are to buy into an agenda that requires patience, sacrifice, and change, the consistent narrative should be signaled from or around public sector frugality, plan articulation, whole of the society approach, and endgame impact assessments built on a whole of government approach. This will be done not as an emblem of good governance, but as an integral part of public accountability. Given that all markets and economies thrive on confidence, it is evident, therefore, that clear decorum and restoration of confidence are urgently required. It is therefore a trite fact that the leadership responsibility of the current economic catastrophe must be anchored to this current administration, and a demand made on the prudent management of the cost of governance, pro-poor and vulnerable members of the society's plans, policy choices, and a better superintendence of the market forces of demand and supply. We must also see this culmination of decades of poor policy choices as an opportunity, a unique one indeed, to address a national problem that requires the effort of all Nigerians, particularly the enlightened citizens, our elites. That said, we need to recognize the current situation for what it is. It is both volatile and dangerous, and we must desist from the blame game that hurts rather than builds the necessary alliances for growth that is required. We have to use platforms and vehicles to build nodes that elicit public discourse to design and profile solutions for our collective good. In confronting the consequential challenges that the current situation presents, we must not repeat the mistake of being tunnel vision and ignoring the opportunities inherent in the dislocations we see. Turning everything on its head through the policies initiated may not have delivered smart outcomes, but it offers the one-off opportunity to reset issues, redress essential delinkages, wean off leeches, and establish an economic order that offers comparative, competitive, and compelling growth opportunities for a sustainable economy. The task is for those of us who believe in and are committed to a better society for all to take this as a challenge. Therefore, while economics will not be an exact science, the reality of our situation is not in doubt, and the solution must have a holistic approach. For this reason, we sought the counsel and expertise of foremost economists with public sector economic management experience, affiliations, with the principals in the government, and more importantly, possessing the trust of the public to offer their thought-led policy options to tackle Nigeria's many variances and offer insights into what the end game would look like as a first step in a series of steps which the managers of the Nigerian economy can build upon. The objectives are: 1, to tell the truth as part of the confidence-building process and show how consensus can be built. The overall approach is to present answers to specific concerns about the country's economic direction. And we believe that we have assembled a panel that is not only competent, but capable in delivering this. This is not intended to be a talk show, but a reasoned attempt to signal options out of the crossroads we are confronted with. I have, as often as I could, offered my personal opinions and directions to steer the Nigerian economy back to progress. I am well aware and grateful that many of you listening also share the same. But I am much more impressed at the fact that the quality of men who are speaking, including some who are my mentors, would do justice to the subject. However, as James Strangulation said in his brilliant book, The Wisdom of Crowds, the knowledge of a crowd results in better decision-making, innovation, and problem-solving than that of an individual. It is my belief, and that of ProShare, that as we allow participants to offer diverse and independent opinions, express their realities, and capture the mood of the nation, we would aggregate a rich collection of submissions and offer a unified strategy advisory for the government. I wish us all a productive deliberation. Thank you.
Nigeria Limited. I'll be moderating today's event with my guest moderator, Malam Suleiman Yahya, OON, founder, Abuja Business Council, and a distinguished economist and entrepreneur. We would first like to establish some house rules. The first, each panelist will spend 2 minutes making opening remarks to set the context for their answers to what has gone wrong with the Nigerian economy. Each panelist would respond directly to the questions asked in 7 minutes. We expect that each analyst will identify the problems in 3 minutes and use 4 minutes to prefer solutions. After all panelists have answered their questions, the moderators would require each panelist to give their closing thoughts in 3 minutes. At the end of each panelist addressing the 4 thematic questions, an open question and answer session will be moderated. To ask questions, attendees should raise their hands to be identified, or they could type their questions in the conference chat box. Questions on subject matters discussed by panelists will be responded to, while comments will be acknowledged. Questions must not exceed a minute. Questions should be directed to specific panelists and it should be issue-based. I'd like to acknowledge that the 4 question areas we would address this morning would be: 1, problem definition; 2, economic roadmap; 3, policy options; and 4, necessary growth areas and imperatives for system stability. We will be engaged with the following panelists this morning. They are economists of unique reputation. They have been involved in both public and private sector engagements, and that has expanded their experience about policies, options, and solutions. The first panelist this morning will be Mr. Bismarck Riwani, the Chief Executive Officer of Financial Derivatives Company, FTC. The next panelist will be Dr. Tilewa Adebajo, the Chief Executive Officer of CFG Consulting Group. Then we'll have Dr. Tope Fashua, who is a special advisor to the President on the economy in the Office of the Vice President. Next, we'll have Dr. Ogo Okiti. After Dr. Okiti, we'll have Dr. Oyeyemi Kale. Dr. Oyeyemi Kale used to be the Statistician General of the Federation and is currently the Chief Economist and Managing Director at the Afrexim Bank. After that, we'll be discussing with Dr. Biodun Adedipe. Dr. Adedipe is the Chief Executive of BA Consult and a reputable banker and economist. Next would be, and certainly not the least, will be Dr. Ayo Teriba. Dr. Ayo Teriba is the Chief Executive Officer of EA and Associates, one of Nigeria's prominent economic consultancy firms. Dr. Teriba is also a member of the Governing Council of the Ministry of Finance Incorporated. We expect that we'll also provide 25 minutes to our distinguished audience to ask questions. I had said earlier, we'll expect that these questions will be issue-based and directed at specific panelists. We will emphasize the following rules of conversation. Number one, there should be no name-calling or use of foul language. Number two, no wild and unsubstantiated statements unsupported by verifiable and publicly available data should be made during the course of the webinar. Now, after clarifying these house rules, permit me to invite Mr. Bismarck Riwani to answer our first question. Mr. Riwani.
Good morning. This is Mr. Riwani here. Can you hear me?
Mr. Riwani, the first question.
Good morning. Yeah.
Nigeria has gotten to a crossroads. How would we define this challenge? What really needs to be fixed? Mr. Riwani, I hope you can hear me.
I can hear you clearly, but
Mr.
if you may
Riwani.
repeat the question. Yeah, can you hear me now? Hello? Moderator, can you hear me? Can you hear me? I can hear you clearly.
Mr. Riwani, could you kindly check your microphone?
Yes, I'm checking my microphone. And my assistant people who should be here are not here. So we'll try again. Thank you.
No, I can hear you, BJ.
You can hear me?
Hear you clearly.
Yes.
We can hear you clearly. We can hear Mr.
We can hear you.
That's what you're here for.
So,
Moderator, can you hear him?
Yes, we
BJ,
can hear
please
you.
Go ahead, BJ.
Dr.
I hear
Rani.
you loud.
Okay.
Yeah.
All
Okay.
right. Good morning, distinguished guests. But I'm honored and privileged to be here today. And the question is that are we at crossroads? And quite frankly, what should we be doing about it? I think that summarizes the entire theme of this conference today. I don't know that we are not only at crossroads, but we are at the point where you are damned if you do, and you are damned if you don't. But if you do nothing, you are bound to crash. If you do something, there's a likelihood that you might succeed. So there are no guarantees that any particular set cocktail of options will take us out. But one thing is sure, that if you do nothing, you are bound to crash. So having said that, the format I heard you saying was that of what we call problem identification. First and foremost, let me say categorically that Nigeria's economic problems are well documented, well known, And actually, the situation has deteriorated over time, over the past 30, 40 years. Part of them are structural, part of them are transient, part of it is due to exogenous shocks, part of it is due to management, and part of it is due to what we call unexpected and unintended consequences. Having said that, for us to focus, I would like to limit us to 4 particular areas. One is that of growth and output. We have suboptimality in growth, suboptimality in output of goods and services, and potential GDP is growing at a rate faster than real GDP. We also have sectoral. I think the NBS released statements yesterday that showed a slight improvement in growth, but if you look at it closely, you find that the areas that chalked out the highest growth are the areas that do not employ that many people. So we have what you can call non-inclusive growth, but also growth that that is skewed in the service sector actually did better than the oil sector. Some sectors have been in recession for some time, i.e. Crude oil production and in some cases refining. And those sectors, even though they are threatened with obsolescence, are the sectors that are the golden goose. So that is the growth and the macro picture. 1, suboptimal growth. 2, non-inclusive in terms of not employing people. 3, the linkages between the sectors are tenuous, and therefore they don't pull the other sectors along with them. I think that's clear. Then there's the other issue that we have to look at, which is monetary. We have monetary indices. We know as of today that M3 growth is as high as 76%. So if you have GDP growth of 2.5% and you have money aggregates growing at, actually growth expanded at 3.46%, and you have monetary aggregate growing at 76%, obviously there and then you have an inflationary underlying structural inflation, which needs to be addressed. You also have interest rates, effective interest rates that are significantly lower than the rate of inflation. So, but in fairness, in the recent weeks, we've seen a movement of effective rates going up, but still far away from the rate of inflation. So that in itself, you have monetary conditions that are loose and monetary policy that is not as tight. In fact, if anything, monetary policy was actually more of easing than tightening. That itself creates a fundamental problem. It makes the currency or the legal tender less of a store of value, and people begin to lose confidence in that. It also leads to the fact that people front load their borrowing. So because in an inflationary environment, it's better to be a borrower than to be a lender. And also the fact that it also puts the financial system, the banking and financial system under strain, and could lead to fail, because when you adjust interest rate eventually, the impairment rate and the default rate in the credit default rate increase, stock market values will sharply deteriorate, and therefore that leads to another set of consequences which don't like. So we've taken the growth sector, we've taken the money sector, then let us look at the fiscal. In the fiscal, everybody knows that there's subsidies, taxes, so there's a revenue gap, there are inefficient taxes, and then there's also leakages, waste, and stranded money and stranded assets. When you put all of that together, you actually have, you are faced with what you may have a negative government multiplier and a negative investment multiplier. Now, so that's the government sector. But finally, and the fourth part of it that we are going to be looking at is the external sector. The external sector looks at your balance of trade, your balance of payments, your investment flows, and to see whether your exchange rate is aligned. We have an exchange rate which has been technically misaligned for decades, and at times the misalignment is narrow, at times it's even wider, and that misalignment, because the exchange rate is what brings consistency between your external sector and your domestic sector, then people begin to wonder whether the exchange rate is the thing that is causing inflation, inflation is causing the exchange rate, or that's like 22 situation. So what are we facing in the external sector? We have external debt that is high, that was used to not to finance any productive activities. We have external reserves that we do not know exactly what the true value of external reserves are unencumbered. We measure and we publish gross external reserves, the moving average, which is not that transparent. We also have an exchange rate, like I said, which and a structural defect in our foreign exchange market. There's the exchange rate, there's the foreign exchange market, there's the exchange rate determining mechanism, and the total imperfections of the market, which is you have three types of markets. You have segmented, you have a price discriminating monopoly, and you have an oligopoly itself. All three are imperfect, but what is more interesting is that the smaller, the bigger and the dominant player becomes the price follower. It's chasing the smaller players. So the price leaders are technically the BDCs and all. So those distortions in the exchange rate or the external sector manifest themselves in the symptoms. So and policymakers now find themselves chasing the symptoms rather than dealing with the structural problems, dealing with the transient problems, and dealing with the problem. And generally speaking, at the end of the day, we find that economists worry about growth and focus on growth. Accountants focus on revenue and how to balance the books. The accountants are always accurate. The economists are always, faced with that dilemma of the paradox of thrift, and also at times whether we're going to emphasize the monetarist approach or we're going to emphasize the Keynesian or fiscal approach. So that's where we are. And if you describe that as crossroads, yes, maybe you're right. But crossroads don't mean anything. The thing is that the options are few and the choices are hard. And that's where I will leave that conversation at this point in time.
Thank you very much. Dr.
Can I come in? Teslim.
Yes,
please.
Is that
a question to Bismarck Rowani?
Okay.
Please go ahead.
Go ahead, please.
Hello?
Mr. Yaya, please go ahead. Okay, Mr. Yaya, since we can't get you at the moment, we will go to Dr. Tilewa Adebajo. Dr. Adebajo, you've listened to the description of the challenge Nigeria faces today. We are aware that CFG came out with a report in the year. How would you describe the Nigerian situation?
sure that things can work in Nigeria today. That is really where the question is for us in Nigeria. Having said that, you have a situation whereby at the time you have 30 trillion in ways and means finance. The total public debt was about maybe 25 trillion. And then, of course, you can see the impact that will have eventually on money supply. So, when you have such a massive distortion or massive shock to your system, you need to address it. And it is now about what the political will is. You know, we have what it takes. If you look at the free fall in foreign exchange, if you take a look at the graphs of how the exchange rate has moved from December to February, from just under 800 now to about 1,800. You know, this is not about market forces. Clearly, there is a problem. It's not about market movement of the economy. It has to do with that. We've got to a stage whereby it's even beyond speculation. It's a complete market distortion. And I think that there's no market in the world where you see this value vibration. So what you're saying is that in dollar terms, values have halved from January to December. The value of every asset in Nigeria has halved by 50% in just a month. We are not accurate. You know, there's no, it's not as if we are being bombed by our neighbors or there's a US blockade on the Atlantic seaboard of the coast of Lagos. It's not the case. Economic activity is still going on in Nigeria, despite and in spite the sort of so-called bankruptcy that we have. So I think what is important for us to address is the sincerity of this government in terms of cleaning up the mess before and setting up a clear policies. And I think I agree with this is the fact that the choices are very few. We box ourselves up to a corner to the fact that the only policy choices we have to make are very clear and limited, whether we like it or not. And one of the biggest dilemma of Nigeria is the fact that, you know, we've not been able to save. Norway has a sudden outcome of $1.4 trillion, which is returned about $216 billion in profit last year. So does Saudi Arabia, Kuwait, and a lot of oil producing countries have somewhere in excess of $500 billion. Under Yar'Adua in 2018-2019, the reason why we were able to survive the global financial crisis was that Nigeria at a point in time had $20 billion in its school. Today, the NSIA and all the other agencies that are supposed to provide stability for Nigeria cannot boast of $200 billion in terms of stabilization support. So therein lies our problems, because a lot of the times the cyclical issues in an oil economy or oil producing economy, we've not been able to address it. And right now, it's not about even crossroads. The question is that the policy choices we have to make are limited, and most of the ones we have to make are going to be very hard choices. And you know, so we don't have a policy options except to that. This is the only way we need to do to move forward. Because as I've said from our report, what is the path from stagflation to economic growth? And my own summary from that report is the fact that there are no quick fixes. It's an 18-month economic recovery period that we have to endure. And during that economic recovery period, we have to listen. Government has to be sincere and committed. Sincerity and commitment to reforms over an 18-month period. We say it's a marathon to recovery, not a sprint. So, to get your economy from stagflation to growth, part of growth will take time. But again, as Bismarck said, the monetary policy has been loose. Fiscal policy has been also challenged.
Thank you very much, Dr. Adebajo. I think we have sorted out the technical glitch with my guest moderator. Mr. Yaya, do you want to follow up?
In framing the solutions, Rwani, what are
Assets. dispensations, which are not supported with a social safety net, you find that you increase income inequality and opportunity inequality and leads to distress. And then you could see what's happening in South Africa and Mexico, where there's high income inequality. It's also followed by violence and resentment. So that is the first thing. You did say that also. What are the things that we should stop doing? So they're pretty obvious. We should stop doing some dumb things. You cannot have a law in 1995 that says the foreign exchange law allows willing buyers and willing sellers to do whatever they want to do. And then the next minute, you identify as a crime what they call currency racketeering. I never heard of that crime before. And then and mutilation. So you cannot have price controls, commodity boards when you're trying to encourage people to bring their money in and trade, bring their money in and produce, bring their money in and get a decent return and reinvest, same. So if we are going for an investment-led strategy, then we should have an investment culture and an environment which is friendly to investments, both initial investments and potential investment. We cannot also, one of the big things is that I see is this whole asset bubble that is being created by stock market valuations, which are totally out of line with reality, a lot of irrational exuberance and misguided enthusiasm. So we need to settle down and ensure that these markets, commodity markets, stock markets, equity markets, and all that, are real markets and not asset bubbles. Because what happened in Southeast Asia in the 90s, late 90s, and what happened in California in the dot-com boom in the early 2000s could happen, but we don't have that capacity to withstand that kind of indigenous shocks that are there. So one, I would say, accept the ideology that you are having a mixed model. Two, that government intervention is necessary to support areas where there are weaknesses. Three, disabuse your mind of having all sorts of price controls or command economy model. You must, a mental adjustment to know that we are in a situation where free markets work and the markets, free market do not mean no intervention. It only means intervention for the common good and the social good of the people. And finally, that investment-led strategy means that some sectors are going to grow, and balance with theory. Some sectors are going to grow faster than others. And because of the strong linkages, they pull the others along. And that policymakers and regulators should be there to intervene positively and not negatively to shackle investor and investment incentives, not than anything else.
Thank you.
Thank you very
Rewani,
much.
I want you to reflect on two things while we ask Dr. Adebayo the follow-up question. The first one is, you talk about the currency market and violations of the law, and you recall that actors since the early 2000s have been involved or complicit in market manipulation. And that is common in all the financial markets and of course the capital market. And we have the Investment and Security Act, which is in abeyance. So while you reflect on that, on the kind of controls that we need to put to strengthen market behavior, I would ask Dr. Adebayo on his framing of an 18-month recovery strategy. Knowing the depth of the problems, the absence of any support system for the currency market. I'm talking about the geopolitics of currencies and how they are supported. And knowing that we are also in an environment where we are witnessing massive supply shocks coming out of COVID. And you need specific policies to ramp up output and productivity. Why are you giving yourself a short-run period of 18 months to solve this problem? What informs this high optimism?
We'll get back to that particular question after we'll take some of the comments from other participants. BJ,
Yes,
please kindly hold on, please. Please hold your thought.
Yes.
Yeah. I think opening comments from other participants. Yes, thank you. Opening comments from
just hold your thoughts on that while the other participants speak. Thank you very much.
Thank you very much. Dr. Tiliwa, just hold your thoughts on that. Dr. Fashua.
Yes,
you've heard about the challenges of the crossroads we are in concerning monetary and fiscal policy. As a person that's a special advisor to the government, where are we? What really is the challenge?
Well, thank you very much. I not because I'm in government, but you know, my own thinking right now is we're actually, yes, at the crossroads, but it points to growth from where I sit. And it also points to a number of behavioral changes that we must now begin to embrace. And so I don't despair. I think that, yes, it's natural for people to be apprehensive, but the government has only been in for 9 months or thereabouts. And even the 18-month trajectory painted by Dr. Adebajo, yes, like was just commented on now, itself is a bit optimistic as well. Remember that even as we speak now, countries around the world are beginning to fall into recession. United Kingdom, Japan, Finland, Ireland, even Germany is on tenterhooks right now. And some of this is as a result of COVID. It's going to be very difficult for countries and the global economy to actually shake off the once-in-a-lifetime experience of COVID, which was perhaps by far worse than whatever could have happened in 1920 when we had the Spanish flu, because for the first time in a very globalized economy that's working on information at the speed of light, we had countries shutting down all over the globe. So we also should give ourselves some benefit of that doubt in terms of, you know, it's easy to dismiss everything as a matter of the ways and means, 30 trillion, and, you know, but I think history also should tell us that those ways and means were not just merely pocketed. Of course, there was a lot of corruption in all the melee, in all of the confusion, but we were through 2 recessions under a particular government. In 2016 and also 2020, which was a global one. 2016 saw a drop of crude oil price to about $25. And of course, we still remain very hooked on that product. You know, so from where I see it, I see hope. I see a scenario where we'll be able to turn things around. And I see a scenario where already things are actually being done right to a large extent. Of course, there may be a couple of mistakes here and there. You know, people will talk about fiscal governance and fiscal prudence and so on. I think we've been fairly prudent in terms of fiscal management. If you look at the 2024 budget, it's sounding and looking like it's a lot better than what we've had in the past. We've tried to reduce, or we're going to try to reduce deficit to about 3%, about 3.4%, down from about 6.8%. And even in terms of share numbers to about 9 trillion, down from about 16 trillion in the previous budget of 2023. So I see hope. However, but on the other side is what the kind of behavioral changes that we have to do. For example, with the Naira where it is today, I'm seeing a lot of people actually changing their minds about their taste, about their even things like foreign education for children and all of that. We're now having to look back and see what other options we have locally. And I think that's the basic idea. However, according to the Marshall-Lerner conditions in economics, which says that devaluation may not help a country if the whatever exports you are sending out is not positively elastic to the devaluation, to the drop in the value of your currency. Meaning that if people are not buying more as a result of you reducing the value of your currency, of the products you're sending out, then devaluation will not work for you. We know that our major export is crude oil, and of course the price is set globally. Even the volumes are determined for us by OPEC. We're not even able to meet that, even though we're doing a lot better in that regard. And I think, as was noted by Mr. Bismarck Rewane, one of the key drivers of the recent 3.46 growth is actually the oil sector. So we're doing a lot better on that front, but devaluation does not particularly drive that. But what we see driving, in essence, is that our food have become quite cheap, much cheaper, going to our neighboring countries, all of whom are francophone countries. The naira, the last time I checked, was almost about 4 naira 80 kobo equals to 1 sefa. They can't believe their luck. However, most of that export is informal export, which is a deduction from our GDP straight up, because it's not captured. The whatever export process is made will not come back, or hardly comes back into this country. That is where we need to be cautious. So I would probably urge that contrary to thinking about reversal of the two key policies that government has done, which is, first of all, the oil subsidy removal, which seems to be coming back now as a result of the drop in the value of the naira, I would say that this is a time to assess and reassess some of these policies. Of course, that
Okay. Thank you very much, Dr. Fashwa.
Can I land?
Dr. Okiti.
Can I land, please?
Three previous panelists define what they see as the problem. What, in your own opinion, is the Nigerian problem? Are we at a crossroads?
Yeah, thank you so very much, Taslim, and thank you to ProShare for inviting me to this distinguished panel. I'd like to echo, some of the things that have been said before, but I think our problems are long-term. They're long-term, and of course, the ones that we have seen in the last few months in relation to the rapid depreciation of the naira, that's the one you call transient. But I think we cannot divorce the current problems from our long-term problem. And what is our long-term problem? We have just not been able to organize our fiscal policy and expenditure. There's no other problem that we have in Nigeria. If you look at the data very well, since the 1970s, we've probably only had a fiscal surplus in probably 1 or 2 years. So we don't have any, whether there's high oil prices or low oil prices, we just keep borrowing and keep expanding deficit and debts. And I don't think there's anyone that has done it more than the last 80. The last 8 years has been a record-breaking expansion of deficit and debts. So we are not able to put a lead or some kind of control on our fiscal policy and expenditure. That's it. So I want you to bring into context one major fact. If you look at major economies, and it's very easy for people to talk about UK entering recession, Germany entering recession, this one entering recession. All these countries don't have the fundamental problems that we have. They've entered recession now. Maybe before the end of the year, they will come out of their recessions and they'll be bouncing back again. But look at it this way. The size of the Nigerian economy in 2014, why most economies have even regained the size of their economy before COVID. In 2024, Nigeria has not regained the size of the economy it had in 2015. So it means that we had a whopping 8 years in which we just move around emotions without necessarily, there was no reforms. We just keep printing money, and that has led us to where we are. So in terms of what we are saying, what is the problem? The problem is a fiscal problem. It has monetary outcomes, it has monetary outlets, but our major problem is a fiscal problem. So the way I look at economics is actually very, very simple. If you look at the family unit, which is the smallest economic unit, and you look at the business, and of course you look at nations, they all face the same budget constraints. So if you look at a family, and you say, oh, you want to grow your family, you want to expand, you want to become wealthy, it is about how you spend your money. The same thing with businesses. Businesses don't just go borrowing and borrowing and borrowing. They have to look at their budget and adjust, but not Nigerian government. Successive Nigerian government just see borrowing as the only way out. Money is the solution to all our problems, and that is not going to work. So we have now piled up all those problems, and we have now arrived at this point where we have. Fiscal recklessness has brought us here, and of course, excess liquidity in the economy. It is easy for us to say, oh, those excess liquidity were spent in some ways, but there was no need for us to have that much excess liquidity in the economy, chasing nothing in the economy, and that's why we are where we are. So what do we have now? We have total loss of confidence. Total loss of confidence, not necessarily because is a willing buyer, willing seller, no, or that there was subsidy. It just means that we have loss of confidence in the naira, in the economy, and by large, some people will say extend it to the government, but I don't think this is about government. We are not sure of what the future holds. And because we are not sure of what the future holds, everyone that have any sizable investable fund that is not meant for its consumption is converting that to US dollar to store the value. So how do we build confidence back? That is the question I believe we should start talking about. We have to build the confidence back. Is it going to be easy? No, it's not going to be easy. Is it 18 months? I don't know. Is it 2 years? I don't know. Is it 3 years? I don't know. What is important is that the government needs to start to do that. So what have I seen in the last 6 months? What I have seen in the last 6 months is a focus and the emphasis on monetary policy measures. That is the one that baffles me, because it's the monetary policy measures will not do it. We need concrete fiscal measures to address the problems that we currently have. So let me run through one or two things. The first one, you have deficit of 9 trillion. And Tope Fashua, rightly said, is about 3.5% of GDP for 2024. But there is nothing that says that we must have deficit of 3.5 GDP. Why don't we have a balanced budget and then build confidence from there? The guy in Argentina came into power just about 3 months ago. And within 3 months, he did all he had to do to arrive at a balanced budget today. So there is nothing that says we must do a deficit of 9 trillion. Those 9 trillion, as we all know and think, they are finding their way into chasing the US dollars. So we need to focus on stabilizing the economy, not on growth. There will not be growth in next year if we don't deal with the macroeconomic stability that we see today. So anybody that has any investment plans, just ask around. We are all running businesses here. If you have 20 million to run the business today, are you going to put it in a business, or you are going to buy a US dollar, or you're going to buy US dollar? The answer is you will buy US dollars. If you have 50 million, if you have 1 billion, are you going to invest in a plant for future production? The answer is no. You will buy US dollar in order to store the value of your money. So the point is, we need to drastic solutions. And look, let the president address the country and say, let the president address fiscal issues. There is so much money still coming out of that fiscal side. Too many leakages, whether it's deficit, whether it's allocation, whatever it is, these are still very significant, and they are finding them way back into the US dollar. And that is what we have to deal with.
Thank you, Dr. Okiti.
Yeah.
Now, I would like to go to Dr. Oyeyemi Kale, one-time Statistician General of the Federation and currently Chief Economist for Afri-Exim Bank. Dr. Kale, most of the panelists have given some insight into where the Nigerian challenge is and what the crossroads actually means. Could you give your own perspective on this? Dr. Kale?
You're muted.
Thank you, Teslim. And also, first of all, I want to thank Prussia for inviting me to be part of this very distinguished panelist. It's usually very difficult to add any new, fresher perspectives when several distinguished people have spoken, but I'll try to avoid things that have already been said, most of which I agree, or say the same thing, but approach it from a different in a different direction. First of all, I don't think Nigeria is at the crossroads because definition of crossroads means you've gotten to a point where you're looking for what direction to move into. I think we've already taken a direction. So we're not at the crossroads, we have taken a direction and moved in a direction. And for the most part, that direction has been wrong. So I think it's even a case where we have to turn around and go back and probably have to reset. I think it's more of a resetting of the Nigerian macroeconomic system rather than at a crossroad where we're thinking of what direction we take. Also, I think there's very lack of understanding, proper understanding, maybe because I handled data for a while, in the way the Nigerian economy is actually structured. Now, some of the panelists have tried to explain. I've approached it from different areas. So it's a fiscal issue, some have suggested exchange rate challenges, output issues. I think we've gotten to a point where like I said, we're not a crossroad, we've actually taken a decision. I think we're at the point where every part of the macroeconomy, whether it's the fiscal, whether it's the real sector, the external or monetary sector, is actually constrained. And it has gotten to a point, in my opinion, where it's difficult to say this is the first issue to tackle because they're all equally important. They're all very significant challenges affecting the Nigerian economy, and tackling one on its own in isolation is going to hit the other one. And I think that's part of the major problems that I want to highlight, the lack of coordination, harmonization. Every different policy maker is just taking a decision without proper impact analysis, or not going to affect the other. So what we need is a combination of harmonized, well thought out, well-researched policies, understand the implication of other parts of the economy and preparing for those impacts. I don't think we do that. Yes, part of the problem, I think Dr. Fascio said so, is the global economic challenges, which everybody is facing. But I think there are two other reasons why, there are three major reasons why Nigeria is where it is today. One, of course, is the external factors like the COVID he mentioned, like all this Russia, Ukraine, now you have Israel, Palestinian conflict, various conflicts, even in the ECOWAS region. Yes, you have the challenges of overdependence on oil, which basically is what I describe as the dysfunctional structure of the Nigerian economy, where directly and indirectly, if you look at the input-output tables, you find that Nigeria is tied to what happens in the oil and gas sector, even though we say 92% of the economy is, or especially more than that now, is non-oil, but the truth is about under 58 to 60% of that non-oil sector still depends on what happens in the oil sector. So when the oil sector tanks, you see that most of the other sectors also tank along with it, even though they are not directly related to oil. So that dysfunctional structure is also a problem. And then thirdly, which is part I want to focus on, is what I call unforced errors. Those of you that are fans of tennis, you understand what I mean. And it's likely just decisions taken by policymakers that take us in the wrong direction. And it might be the right decisions taken at the wrong time. It could be the right decisions taken without the necessary supporting structures, or it could just be the wrong decisions. And we've been known to do all three. And I think that's partly what has gotten us to this state. There has been very, very limited cost-benefit analysis. There have been very limited impact analysis done before policies are thrown out. There's very, very little coordination, harmonization. And when that happens, it breeds what Dr. Kitty said, it increases that lack of confidence because it creates a situation where people, the household businesses have the impression that policymakers are not sure what they are doing because you introduce a policy, it affects a different sector or a different area. So you have to withdraw it or amend it. I keep tweaking, going back and forth. It creates that opinion that you don't have a structured system. you create a budget that does not match other policies, you create an external policy that also contradicts another policy. So it gives that impression of lack of coordination, lack of harmonization. And when that happens, confidence in the macroeconomy just tanks, and people start betting against the economy, and it exacerbates the kinds of situations where we are. So I would just, my position is, look, I think we've gone to the point where I don't think we should be tweaking. So it's fiscal. Let's go and see how to cut expenditure. Let's try and do revenue. That's the problem. Oh, it's excess money supply. That's the issue. Oh, it's the exchange rate. We need to get more dollars and get more clarity with. I think we've gone past that. I think everything is now interconnected. Everything is extremely important. We can't be picking and choosing which one matters. I think we have got to the point where, yes, we have to pick a strategy. Stick to it, keep faith with that strategy. But along the line, make sure that the proper sequencing, we are moving from one issue to the other. We're explaining very, very clearly. We fully understand the implications. It's going to hurt other areas, and we are fully aware of where it's going to hurt. We are introducing policies to minimize the hurt. And you are moving from one issue to the other in a very systematic, harmonized, coordinated manner. Otherwise, we're just going to be picking different policymakers that are just picking different things. And as a result, we have been hit on all sides by the response to this way of running government. And I think I believe that is the way that at this point we have to go. We need a complete reset. We need to pick a lane, decide what we want to do very, very clearly, and ensure that it's broad-based, ensure that it's well articulated, ensure that it is coordinated and harmonized, and move in that direction. Thank you.
Thank you very much, Doctor. Dr. Biodun Adedipe, you've done tremendously well in articulating issues in the financial services sector. You've also been a major commentator on the Nigerian economy. So, in your own eyes, what really is the problem with Nigeria, especially the economy? Dr. Adedipe? Hello, Dr. Adedipe? Okay, Dr. Adedipe is not online at the moment. A bit of technical glitch, I suspect. Dr. Ayo Teriba, Economic Associates has analyzed extensively the global, continental, and national economies. In your opinion, what is the problem with Nigeria? Dr. Teriba, please.
Thank you very much. Well, good morning, distinguished panelists, distinguished audience, and we are grateful to COSIA for putting this forum together. And I've been privileged to learn from the wisdom of all the panelists that have spoken before me. And so it makes my job easier. I would have fewer things to say, and then I can afford, therefore, to try and have some clarity about those few things I have to say. You know, we're talking about crossroads, whether we're at crossroads or the other, it not be the best way to help the audience. If you take the patient to the hospital and the doctor comes out and says that I think the patient is at risk, or the patient is not at risk, you have to be specific. You have to. Nigeria's problem, easiest way to describe it, and it ties with a few panelists have mentioned a number of other economies that are in decline. Some say in recession. Japan, you can say Japan is in recession, but Japan has been declining for 1 decade, just like Nigeria. Brazil has been declining for 1 decade, just like Nigeria. And the Euro area countries had been struggling to grow for 1 decade, stagnated. They've not been able to gain altitude. They are beginning to lose altitude now. So when you say recession, it's not only Nigeria that has been in and out of recession. Well, a bigger GDP 2015 than we are today. So we've been on a decline, and they have been on a decline. So it says, and Nigeria is not an exception. So it makes Nigeria's situation typical. We all will chorus, we are in a post-industrial phase. Industrialization is coming to an end. If it's not that, it has come to an end. And this industrialization is about producing to get wealth. That model, benefited the world for centuries, but over the past decade, it has expired. You are more likely to stagnate, relying on production, because many products that were pathways to wealth have been replaced by services. Imagine crude oil and solar energy, for example. And unless you find a way to reduce your dependence on production and look for post-industrial pathways, you'll be stuck in the crisis as we have been for, you say, 80 years. And as these other countries we're talking about have been stuck. And the counter-argument is to look at the countries that are not in recession and the countries that have not been declining, the countries that have been growing steadily. We find that they step back from dependence on production, on output, dependence on GDP. And so you have two fundamental bases, platforms on which you can, base your economy, base your fiscal narrative, base your monetary and financial narrative. It's either you are basing it on your income statement, which is what industrialization is about, or your balance sheet, which is what the post-industrial economy is about. Nigerians and we Nigerian experts have to unlearn many of the things we have learned about income statement management and learn what we need to learn about balance sheet management. Nigeria's balance sheet is neglected. The government of Nigeria more or less has no balance sheet. The only component, that is active on our balance sheet is debt. If we have assets, we have to be debating what the assets are, what their values are. If we can rely on equity, we begin to debate, which assets are eligible, and that's the source of our tragedy, that's the source of our poverty. I've held this view since 2015, and Bismarck and Yemi Kale were in the room when we spoke to the economic management team in August 2016, in the heat of the recession. Rely less on your income statement, embrace your balance sheet, rejuvenate your balance sheet. We failed to do that. Our balance sheet is as weak today as it was then. Look at India, that is growing. Their balance sheet is their source of growth. And their GDP, been gaining $1 trillion more. They say from $1 trillion to $2 trillion took them 8 years. $2 trillion to $3 trillion took them 5 years. It remains to be seen how long the journey from 3 trillion to 4 trillion will take them. They've moved from being 10th GDP in the world to currently 5th, and they will soon be 3rd. They will overtake Japan, they will overtake Germany, and be 3rd. Because Germany and Japan is unable to let go of industrialization and export. And it's not just Germany, all the Euro area, countries benefited from industrialization and they are now fatigued by the fact that we are in the post-industrial phase. They can't learn, how to adjust from the post-industrial phase to from the industrial phase to the post-industrial one. Until they do, they will be stagnant. So until Nigeria learns to speak less about GDP, about LGDP, the value you were extracting from your oil in terms of value added from oil a decade ago was bigger than what we extract now. Dangote refinery there, I understand, is recruiting 11,000 Chinese and Indian managers. And that you can't run a farm in Nigeria today unless you go and employ a Chinese or an Indian farm manager or an Indian or Chinese factory manager. So the value added in farming, when you are saying go and cultivate more farm, is going to be taken away by India, not retained in Nigeria, China. So the value added, if I stop talking about those. Now, India, you are paying Indian skills or Chinese skills. That's one of the things you need to build to benefit in the post-industrial phase. Now, specifics of the current year budget, I'm disappointed because the current government raised our hope and they came in saying that we will stop borrowing, we will attract foreign direct investment, we will attract domestic direct investment, PPP, diaspora. But the budget came out and there's no reference to it. We have deficit of 9 trillion, you could have deficit of 20 trillion. How you finance it is what matters. We're talking about multilateral projects, talking about 1.5 billion funds. So where is all that talk about foreign direct investment? Where is all that talk about domestic direct investment? Which is the way forward, which is the right things to say and do. So until you begin to do that, until Nigeria turns to the assets that it owns, until we begin to take state-owned companies to the market to establish their market value and leverage on their financial value. I don't know which company in the world today will prosper by selling and being absent in the stock market. Most companies are facing the post-industrial blues that earnings are shrinking, but market values are soaring, and the way to create wealth is on the balance sheet. So unless we are ready to do that with the companies that we own, we are ready to do that with the real estate that Nigeria is the only country in the world now that has real estate and will not benefit from it, will not prosper from it. They will be idle. Federal Secretariat, National Stadium, put a barracks next to a Atlantic City, a barracks next to Ikeja, GRA. You watch the private sector unlock wealth from real estate, and we keep our own idle, and we say we want to go and borrow abroad. Turn to your assets. We have infrastructure that can unlock wealth from. They're the only ones that will build runway and not build terminals. Many other countries around the world make more money from their terminals than they make from their runway. So basically, Nigeria is not at any crossroad. Nigeria has faced a dead end of trying to rely on income statement. So we've seen the limits of income centrism. And we are beginning to see the perils of continuing that path, the soaring debt. You are borrowing more against declining income. And we now need to explore the possibilities of asset centrism and, see the benefits, reap the benefits like Saudi is reaping, like India is reaping, like the United States is reaping. These are the countries that have grown steadily in the last decade and will continue to grow, but they grow from the balance sheet and it benefits the income statement. So the long and short, of the situation is that we are not at any crossroad. We are at one dead end. The traditional fountains of our liquidity, of our fiscal vibrance, of our monetary vibrance have dried up. But new fountains are springing, and those new fountains are on the balance sheet. Instead of waiting for IMF to give us 2 billion or 3 billion, turn to the balance sheet and unlock 30 billion. Thank you very much. It's my view, and I hope that Nigeria will find a pathway towards that. Do you have 18 months? I'm afraid not. If your patient is already convulsing, you can't be talking about 18 months or more. So if your engine, you've been seeing this check engine signal, check engine oil signal, check engine oil, and you've ignored it up till now, and the engine is beginning to smoke, you don't have 18 months. There's fire on the mountain. You have to stop everything you are doing and put the fire up. So the crisis of our exchange rate is the reserve inadequacy. Exports won't give you the reserves. Production won't give you the reserves. So you can turn to assets. You can decide which assets you want to offer investors to attract foreign exchange and shore up reserves. And you can do that. You can, sell shares in the companies that you own within a month and 3 months. You can leverage your real estate assets within a month and 3 months. And you certainly can, explore, infrastructure opportunities, in terms of attracting investment to them within the space of a month to 6 months. So you don't have 18 months. All you have is about 2 to 3 months. Because if you let the exchange rate slide, if you let the exchange rate slide continue and blow out into, an open socioeconomic crisis, then it would have been too late. Thank you.
Thank you very much, Dr. Ayo Teriba. Very insightful thoughts. I'll go around this. I'll go to the second round of questions. We'll concentrate primarily on policy solutions. How do we get out of the mire? Do we walk back from what somebody had said was a dead end, or do we just try to push ahead along the wrong track, or do we just decide that we stay where we are? These rounds of questions, I will begin again with Mr. Bismarck Riwani. I would also like to call my guest host to lead these conversations strictly on policy options available for the Nigerian economy. Mr. Yaya.
Thank you very much. My questions would now go to Pifashwa, Chief Advisor. I think you've asked the question rhetorically that should we go back or should we refine the conversation? I think from what I heard from the panelists, it is not about going back. It's about dimensioning the consequences of the two actions and agreeing on what kind of impact assessment and what incentives do you have to create to provide the economy, to rejuvenate the economy. For instance, the absence of a model, also absence of a federal government, and maybe to make your job easier, there will be shift in behavior, and then there should be shift in incentives. Which sectors are we looking at to propel the new economy that is being envisaged under this shifting strategy? Because we cannot rely on the old economy. Incentives would be required from government to create jobs for the teeming youths and to shift skills, and especially against the background that a lot of the young people are jabbering, and because they've seen their earnings in real terms becoming very, very little. So most of the white collar jobs, the skills living in Nigeria in large quantities, and this also affected the blue collar job because we've seen even technicians now leaving the country. And then we're in a space where our competitors are sharpening their IT game, they are sharpening their biotech games, they are sharpening their energy technology game, and then you have climate change as a headwind. So what shift in policies should Nigerians expect, and what kind of incentives are you going to give, offer Nigerians that would make them change the behavior that you envisage?
Well, thank you very much. I'll try and speak very quickly so that I'm not timed out again, like the last time. So I mentioned, I noted here that, for example, we need to look at some of the new ministries that that was created under the President Bola Tinubu administration. For example, of course, we're powering up the digital ministry. We have the blue economy, which has never been in place before. That opens a whole vista in the economy. Also, we have a gas ministry which focuses on gas. We have a steel industry, steel ministry that focuses on steel. So also we have creatives, okay? Because again, creatives is actually one of the things that Nigeria pushes these days, and that's very, very critical. In fact, it doesn't feature at all in our GDP. Equally, e-commerce doesn't feature in our GDP. So we're spending, there's even a project under the Vice President office where we're getting about $617 million to power digital industry and creative industry. And it must be noted also that a lot of our young people are now working remotely for many companies abroad. Sometimes we don't even capture that at all. So there's been a deliberate move to shift from the past and do something new. Equally, I'm proud to piggyback on what Dr. Teriba said. Dr. Teriba himself is actually a part of MOFI. MOFI is all about optimizing the government assets. So it depends on how quickly that initiative moves. I think on Tuesday, they had a meeting where they actually articulated what they wanted to do. So in terms of optimizing government assets, like Saudi Arabia, I think we're already on course to that. How quickly that comes in too could also correlate with how quickly the foreign direct investment that was promised, or foreign portfolio investors, which he said has not come in on time. He also has to prepare for a scenario where that doesn't come in on time. In terms of achieving, fiscal balance and fiscal prudence. In terms of, I would want to comment on what Okiti said. Which is a bit, uncharitable to government, but it is what it is. If we're asking to go down the Argentinian route, remember that Argentina is a case study, a world case study in volatility, up to date down to tomorrow. We haven't even gone through some of the things that country has gone through. So if Milei says he wants to balance his budget 3 months coming in, it's a promise. Whether he's able to do that at the end of 1 year is a different ballgame altogether. If we're saying that we should balance our budget in 9 months, well, it's a tall order, but economics is not practiced that way. It's not, you're not experimenting with the people. So you want to balance your budget post-COVID in 9 months? I think that's a bit of I think that reducing the deficit by half is a better strategy to go down, and then we see what happens in the next year. So again, note that the fact that our budget is the second smallest budget per capita in the world. When I did that analysis in 2018, I realized that we're only better than DR Congo. However, chances are that it's even worse today. 28.7 trillion, if you divide it, and by ongoing dollar rate, is probably like 19 or 18 billion dollars, meaning that we're budgeting less than last year. What then are we budgeting? We need a bigger budget than a smaller budget, except you don't want the country to provide for its people. So this is not the time. But however, I see that nobody has actually mentioned that the behavioral issues that I'm talking about, how much of our own behaviors and tastes are we ready to change? See, we cannot dump everything on government. We are government. Everyone here is in government. Most people on this platform have been in government, either as advisory or even in the active executive capacity. So it is what it is. So, but anyway, the government is actually doing something tangible already, which some of which I've mentioned in the past. We are repositioning the ministries. We're reaching out more to the people. We're trying to, even the two policies that have been taken, which is putting us under immense pressure, which is the fuel deregulation. The fuel deregulation for me is not a problem per se, because we had gone through all of that argument about whether it was real, whether it was fraudulent, whether it was time to actually say, let's move on from this. However, what complicated the issue was about 2 weeks after, in accession to the moves by IMF, World Bank, and many of my liberal thinking economists here, the government floated the currency. So in floating the currency, that now has a pull and push effect, the kind of centrifugal effect on the fuel price and on everything else. The issue now becomes, for how much longer can we float the currency? As Dr. Teriba has said, we cannot just afford to just look at the currency just taking off and disappearing, and we don't want to have socio-economic issues. Of course, although Kitty did mention the fact that people would rather invest in dollar than invest in anything else. Fine, fair enough. If anybody that wants to keep keeping their money in the dollar, fair enough, however it is you find it. I perhaps will say, and I'll go out on a limb here to say that the black market for dollar is not our benchmark, should not be our benchmark. In that market, there are so many impurities, and I was in the Nigeria Economic Society discussion at University of Ibadan yesterday, at which Professor Olofin also mentioned this, that whereas there's a law, maybe sometime in 1995, which needs to be looked at, that kind of legitimizes everything that happens in the so-called parallel market, which I don't call parallel market. Black market is what it is. Whereas there's that law, but at the end of the day, the country must do something about that law. Otherwise, the tail will continue to wag the dog, and we don't want that happening. So I want to say that the present government is thinking—
Thank you very much, Dr. Fashua.
Yes. Okay,
Thank
fine.
you.
I hope I've been able to get a few points too. Thank you very much.
Mr. Yaya, we can move on to the next panelist.
Right, exactly. I would like Dr. Yemi Kale, would like to first recognize that you were a champion of rebasing the economy, which moved the economy from somewhere around 300 to 500 billion.
Sorry, Mr. Yaya, we cannot see your face. Could you kindly put on your video?
Right, thank you. My video is on. Can you see me now?
No. No, please continue. Please continue.
Oh, okay, perfect. If you can hear me. Sorry for that technical glitch. So, Dr. Kale, what would you do differently? This shocks, the first impact has been a collapse in GDP valuation in dollars. We've moved from 440 billion down to about 370 billion and still counting. The size of the economy in Africa has moved from 1 to almost number 3 or number 4. And then the government expectation when they came in was they wanted to grow the economy to $1 trillion in between 5 years to maybe 7 years. So what would you advise them to do differently as part of the restructuring the perception of the economy? Because foreign investors, when they look at the big shift, it affects their perception and their decision. It creates a delay in decision to invest in Nigeria. And that's, I think, what is happening today. Like the coordinating minister said, we've done some of the boldest, taking some of the boldest steps, and we should be rewarded. This reward is not coming. What should the government do differently, Dr. Kale?
Thank you. I don't want to repeat the same, should I say, hackneyed speeches or infrastructure development, diversify the economy and things of that. Because I mean, this same question you asked all of us, we'll say exactly the same thing. We have said the same thing in the last couple of decades. I think just to answer your question directly, I think it starts with properly understanding the structure of our economy, and that's part of the reason why, like you mentioned, the rebasing was done. I think there's a need to do another one. Dr. Fashua was saying e-commerce is captured. I don't think that's the problem. It is captured in the GDP, and I think he also mentioned that if I understand the way it was done, and I'm assuming it hasn't changed. He also mentioned the fact that our agricultural output taken over the border is not. It is captured. It's just maybe the exports are not captured because the inform what the production is. So the issue is not it's not captured. It's more better capturing of those activities. Obviously, wherever you consume, as long as you're using the consumption the expenditure approach, no matter where, regardless of how you make your money, if you spend it in the economy, as in the economy, will obviously be captured. So the executive will capture most of it. So better capturing of the economy. And if you look at the way the current economy is structured, I think it's also leveraging on the sectors with great potential for growth. And I don't think we are doing that significantly. Take, for example, solid minerals. The prospects of our solid minerals sector in terms of being able to grow stronger is huge. We are still focusing on the same areas. Government is still devoting money, resources, policies, ideas to the same areas that we have over the last few years. We are still concentrating on giving fertilizers to largely rural farmers, but not rural, subsistence farmers. The same way, just for subsistence, as opposed to ensuring that we move it from subsistence farming to corporate farming, large scale exports, agro processing. We are still doing more or less the same. We say it, but we are still doing more or less. We are still operating the same structure. We are still concentrating on the oil and gas sector. We are not doing enough to boost sectors that have huge opportunities for growth and also have huge export capacity, because if we're able to increase that export capacity, that solves the GDP problem in dollar terms, because you're exporting more from your and your GDP is growing accordingly, and that affects your exchange rate as well. So solid minerals, we're not exploiting that. There's a huge opportunity in the entertainment sector that has gone all over. I mean, grown really significant. We're not exploiting that. I mentioned agro processing, huge opportunities, taking advantage of the global economic challenges where supply has dropped in so many regions. Now with the Israel-Palestinian conflict, supply bottlenecks for every exporter around that Sahel region. So there are huge sectors that we tend to be ignoring in favor of doing things the exact same way. So if I was government, I would look at those sectors, some of which I've mentioned, ICT, for example, financial technology in particular. We'll look at those sectors that have huge opportunities to grow, and not just trying to maintain the same trajectory, the same structure, the same pattern of growth that we've always been doing. If we do that, but it's not going to take us anywhere, and that's the truth. We have to explore new areas that have huge opportunities for growth, some of which I've mentioned, and the focus should be on those, how to unlock those areas of growth. I think that's probably the way we're going to be able to expand that GDP to the point where we're able to grow double the size of the economy in 7 years. If we continue with the same pattern, it's not going to happen. I disagree slightly with Dr. Fashua as well, in terms of yes, there's a new focus on maritime, creating a ministry, but it's not as if it's a new area of economic operation. It's not. It has always been there, but yes, it's a good thing that we're paying more attention to it by making it a ministry. But it's always operated. The maritime sector has always been there. It was just under a different agency, but now it's been given a bit more focus. So again, like I said, do a proper study, understand the structure of your economy, know where the potential growth is. MBS came out with a study a couple of days ago saying that about 80% or was it 80 to 90% of the workforce in Nigeria were self-employed, for example. Now, if you understand what these self-employed Nigerians are doing, the sector they operate in, then you can use that as a way to grow those sectors where 80% to 90% of your economy is functioning, rather than getting them to just be doing. Many of them are doing this thing just to survive. But if you understand what they are doing, the sector they operate in, government can introduce policies to help grow their business, to encourage them to expand beyond just subsistence and trying to survive. Before you know it, they become big export centers. You grow your GDP, you grow your export earnings at the same time.
Thank you very much, Doctor. Mr. Riwani, I would like to come back to you quickly. We've listened to some of the panelists. What are your own recommendations concerning immediate policies that need to be put in place to resolve the Nigerian challenge?
I don't think that we need new policies. I think we need the institutional reform to ensure that those policies are impactful. I think if you've decided that you are going to reduce subsidy and you're going to deregulate the foreign exchange market and make it more efficient, then the institutional reform to support those policies to make sure that the impact is felt positively, and intervening when you are getting unintended consequences is the thing. The policies don't need to be changed. The policies are okay. The understanding of how your economy is structured and how you are going to apply the sequencing of these things are what is important. Some people use an umbrella to say it's implementation. It's not implementation. It's an understanding and sequencing and tinkering with you as you go along to ensure you achieve the desired objectives. I think there's a big difference between that and just announcing policy changes without thinking about the fact that institutional reform, support the policy changes, monitoring, enforcement, and all of that to ensure that we get to where we're going. And understanding also that the things outside your control are probably more than the things within your control. So you must come to terms with that reality. There's the reality check that is there. And not to, because you're in a storm, in aviation, those who know aviation very well, the worst thing to do in a storm is to try to change route or turn back because the aircraft goes right down. So you got to stay the course and you have to precisely know where your destination is. I get the impression that in most of these policies decisions that the destination was not clear. The path, the path to that destination was also not clear. So the critical path analysis was not done. And so we are where we are. It is now time. It's now time to accept those realities and begin to chart your course around the way you're going. But also there is a need for competence. Competencies that are, the skill set and competence of understanding background, for understanding the issues, and therefore able to solve it is a major issue. I've seen a lot of appointments that are being made, and quite very interesting appointments, and been in the business world in this country for decades, and I have a sense of what is required to achieve certain things. I don't come away with a view that Nigeria is playing with its first 11 at this time, even though we are in the knockout stage of like the Champions League. We are still playing with our second or third 11, if not fourth 11, in some areas. So I think one, let me be very clear. One, we must know exactly what we want to do, and I think that is that policies are not bad. That the institutional setting which we are using to achieve the goals may not be adequate because it's fraught with all sorts of frailties, and that the competence, the skill set and competence level required to accomplish these goals at a time of stress is you require more of that depth to do that. So there's a general level of shallowness across what I see, and therefore we have to address that. Either you equip them with the tools, or you change some of the people so that you can get people who have the capacity to deliver quickly. And this is, I'm not indicting the people who selected them, I'm not indicting the people that are there. This is just my personal view that I think that we are at the knockout stage of a tournament, and we are still using our third or fourth 11. I think that's my view.
Thank you very much, Mr. Riwani. Dr. Adebajo, we've listened to quite a number of the panelists and their opinions about policy implementations that are needed urgently. What would you say your own view is? What policies do we need urgently to address the Nigerian situation?
Thank you very much for that.
Dr. Adebajo.
Yes, can you hear me? Yes, thank you very much for that question. Dr. Adebayo, I think you're muted.
No, it's not muted. Please,
I'm not muted.
Okay, you're unmuted.
Yeah, we can hear him.
Yes, we can
Yes,
hear
we
you.
can hear you. Yes, please. Thank you very much for that question. And I think, as Dr. Kale said, I think we have a lot of distinguished people on this forum, and they've all spoken very well. And it's very difficult to disagree with them. But what I want to say without fear or favor is that I had an interaction with the Minister of Industry, Trade and Investment on Wednesday, and I've also met briefly with the Finance Minister at the session at MOFI, where they were looking at the Public Wealth Management Conference. And one of the things that I think is quite essence, especially with government, people in government, is that you cannot be, you need to listen, and you should not be defensive. A lot of times what people are saying is to help out because the numbers don't lie. If we were in Uhuru, people will know that we're in Uhuru. So what do we really need to do? I think one of the most important things is that government itself needs to curtail its spending. That is the number one problem. So if you ask us what you need to do, government needs to curtail its spending, and they should think about implementing the Oronsoye report. You know, you cannot keep telling us that you have a revenue problem when you cannot generate the revenues. You are not generating the revenues. So you are going to have that challenge. So let's resolve that one for all. Government needs to put its house in order in terms of the fiscal challenges that we're experiencing at the moment. And I think that itself, without a doubt, is one of the biggest problems in Nigeria today. And I think...
What happened to his volume? Dr. Adebayo, could you kindly unmute?
Okay, can you hear me now? Very much. Yes. So can we also have a situation whereby foreign exchange management is very important. You can't just go and bid any amount. There has to be caps and floors. Let's have a proper market, even though if it's limited, because removing subsidies on a petroleum product that is imported and devaluing your foreign exchange mechanism, it's counterproductive. It will result eventually into a zero-sum game. So going forward, my own final recommendation is that the most important thing government needs to do after it controls the expenditure is that the central bank now also needs to bring inflation down to critical levels. Historical research and data has shown from what we have seen that if you take a look at 2 points in Nigeria, when GDP was in growth of excess of 8%, the charts that I have done historically from the relationship between interest rates, inflation, and exchange rates, sorry, not exchange rates, inflation, interest rates, and GDP growth rates. If you take a look at those three criteria, the periods of time in Nigeria when we achieved GDP growth in excess of 8%, inflation was within the band of 11 to 12%, and interest rates was within the band of 12 to 15%. If we can go back to those parameters, you can check the numbers. Anybody can check those numbers. Do the regression, do the statistical analysis, do the correlations. If we bring our inflation down to 11%, 12% at the minimum, and we take interest rates between 12 to 15%, that's MPR-based rates, Nigeria will experience 8% growth. So you need to bring the economy into those dynamics. So you can look at it. What did we do right when the economy was growing, GDP was growing in excess of 8%? You will see those parameters. Take us back to that area, and then you will see the results. What is the credit rating of Nigeria today? CAA1. It's junk bond status. Our Euro bonds and our credit risk default swaps are reflecting that premium. We are no longer on the JP Morgan Emerging Market Index. So that means that a pension fund manager managing all the California teachers' pension fund in America cannot make a decision to throw money into Nigeria because we are not on an emerging market index. Being on that index gives those pension fund managers the confidence to throw money into Nigeria. They are managing trillions. They only need to diversify their 0.5% of their portfolios. What is also going to help us when we talk about external shocks is that interest rates are still high in the Western countries. And with all due respect, let everybody understand that most of the Western countries, when they ask me about my 18-month projection, it took them 1 year, the US, to reduce inflation by 50%. Both the European countries and the US achieved inflation reduction in 1 year by increasing their rates. It is a standard and classical method. So that is why I have given Nigeria 18 months. That if in the next 1 year we bring our inflation, and the central bank governor has targeting inflation at 21%, if we bring inflation down, go back to the parameters that are growing our economy, the rest of the economy will take itself out. And then who are the people that are going to invest that will make Nigeria work? Dangote's investment is $18 billion in the refinery. Nigeria's capex is half of that, even if it is close to that. Dangote has paid down that refinery to about $3 billion. The question we're asking ourselves is, which is the next investment Dangote is going to make to be able to boost some Nigeria's economy? What incentives are we going to give him to invest 18 billion in another sector? The LNG, Train 7, they've already said they're not, that's a $7 billion investment. They've already said they're not doing Train 8 because of gas constraints. Train 1 to 6 currently is at 50% capacity for gas availability. So we have a lot of constraints. So we need to get Aliko, Samad, Femi Otedola, Mofe Boyo, Wale Tinubu, all the other entrepreneurs and all the new generation fintech entrepreneurs to begin to invest in a particular area. Once you do that, then all the other FDIs will come through. It is not government that is going to do these things. They need to push these entrepreneurs into particular investments for things to work out. Shell was in Nigeria for a long time, but they are not going to build an $18 billion refinery in Nigeria. It takes our Nigerian entrepreneurs to do certain things, and we need to give them that investment. So it is the private sector that is going to drive the investment, because Nigeria's capex of 9 trillion, we cannot even fund it. We don't know where we're going to finance it. So government should focus on bringing down inflation, reducing its expenditure, creating an enabling environment that will encourage certain entrepreneurs to make the necessary investment in the key sectors for growth. Once you have inflation stable, price stability, history suggests that our GDP will grow in excess of 8%. Thank you very much.
Thank you very much, Dr. Adebayo. Dr. Okiti, we've listened to Dr. Adebayo. We've heard some of his submissions concerning what needs to be done. It would be useful to have insights into your own thought process as regards what needs to be done at this moment. Dr. Okiti, please.
Yeah, thank you so very much. And I mean, there's been very, very insightful recommendations here. So the points I'm going to probably be similar, and I'll just try and build on some of the points that have been made, because I quite agree with most of them. I think the only thing I just want to say in terms of where we are today and how important it is, I'm an economist, but I am probably more, I look into social conditions deeply. From what I see around me at the moment, we have a near collapse of social cohesion in the country. a near collapse. We are not there yet, but we have a near collapse of social cohesion. So it means that, as Dr. Teriba said, the house is on fire. When the house is on fire, this is not the time for me to think of growth. I don't even think of growth. I don't talk about growth in my analysis today. We have to have stability. So there are 4 options in terms of having that stability. Is either the government begins to save drastically, and it should. There's no reason why the government should not save. Anyone that is familiar with government expenditure in Nigeria will tell you there are 2 problems with government expenditure. Government expenditure is only bogus in numbers, not very, very little in impact. So you can have increase in government expenditure without any impact on economic growth. So you have to save. The second, as advanced by Dr. Teriba, his concession, or you sell asset, whichever name you want to call it, you either do that. So that's another option. You have to do it immediately. The third one is to borrow. But the point is this: it doesn't matter which avenue, you have to grow your reserves immediately in order to start to stabilize the naira. So that is number 1 point. After we have now done that, my focus, in my own opinion, will be the intractable and the lingering power crisis in the country. For me, I feel very, very ashamed that we just keep moving from one government to the other. So I'm not going to blame this government because they just came in. But we move from one government to the other and we are just stuck on 4,000 megawatts. I mean, it's just the most ridiculous thing that I think is happened to Nigeria, in my own opinion. Power. So whether it's small-scale farming you want to do, small-scale production you want to do, even you want to study in the night as a student, or you want to work as a professional in the night, we all suffer from this power issue. So I think that would be my next point. The third one, I think it would be the oil and gas. And the reason why oil and gas is very important, and this is one area I commend the present government. The oil and gas, whether it's climate change or solar, whatever it is you want to do, oil and gas can still give you some 20, 25 years solid revenue if you make the right investment today. So I will focus on that. Then the fourth point, in my own opinion, is that the solid mineral sector at the moment have very, very weak fiscal incentives. I don't know where that came from. But you just go to Abuja, go to Nasarawa, go to Kaduna, go to Niger, go to all these states. People, the Chinese or Indians or wherever, Nigerians, everybody is just setting up solid mineral companies from here, and picking wherever it is that they want to pick. And the government is not benefiting at all. So you need to actually deal with that. For me, if you deal with those 3 things in the medium term, then we can begin to look at growth. Of course, there are the monetary policy measures, which I think Dr. Tilewa has explained very well. I don't need to go in that. For me, this will be the first, but the number 1 is you have to quench the fire. And without fiscal initiative and measures, we will not be able to quench the fire. If we continue to rely on the Central Bank of Nigeria, on their measures, the MPCs on Monday and Tuesday, they will raise rates. I mean, we know that they will raise rates, but it's not going to have the kind of impact that it will have when you still have enormous leakages, significant leakages in the fiscal sector. Whether it's federal, whether it's state, whatever it is that is happening in the fiscal sector, you have to deal with that. Thank you so very much.
Okay, thank you very much, Dr. Okiti. Online we have a renowned economist, a person I'm sure we all respect very highly. Is Professor Akpan Ekpo. His hands have been raised, and I think in the order of events, it will be very useful to listen to Dr. Akpan Ekpo. Dr. Ekpo, if you are available, could you kindly speak? Oh, okay. I understand that Professor Ekpo has gone. Okay, so finally, although he had made some recommendations. Okay, finally, although Dr. Teriba has made some recommendations, however, he has heard from his colleagues, I was wondering whether he wants to make some final words on policy recommendations required at this point in time. Very briefly, Doctor.
But they only have 500,000 lines. Now we are talking about 200 million lines. So you are talking about sectors with large absorptive capacity. And I will see nationwide real development using private investors as the next target, or real estate development or transmission development. There are private transmission and real development projects.
One of the questions that we got was, and she noted, a country like Kenya has been able to focus on FX stabilization and shown clear policy coordination between the central bank and the fiscal authorities. Can the speaker that is in a fiscal policy advisory position be crystal clear on policy reforms to reduce fiscal deficit and to contain cost of governance? His comments are way too generic. Well, I think we need to, these are issues that need to be addressed very, very critically. We talked about the fiscal spending being large and needs to be contained. Is this a position all the panelists agree on? Do we feel that the problem is not necessarily monetary, but fiscal spending? And yes, we agree that there needs to be greater coordination between monetary policy and fiscal policy. But what, Mr. Ariwani?
I'm here.
Yes, so are we, is the government spending too much? And do you perceive a lack of coordination between fiscal and monetary policy?
No, first and foremost, the counter-cyclical Keynesian policy means that when an economy is facing a slowdown or a threat or its growth, you actually spend more. But it's not the quantity of spending, but the quality of spending and where it is targeted at. And if you are spending in sectors that have greater linkages, then you would have the multiplier effect kicking in and having an increase in income, GDP. Also, are you spending in those sectors that employ people? And are you investing in those sectors that reduces the cost, the average cost of production for Dr. Kitty, in the fact that this is not the time to save, this is the time to spend more. This is the time to spend more in the terms of quality. And let us not mix spending costs with leakages. They are two different things. If you are spending and there are leakages, then you are not spending. But leakages have a negative multiplier. It drains out of the capacity of the country to grow. So to make a general statement to say that this is a time to stabilize the economy, I agree that it's time to stabilize the economy. But stability does not mean a cutback on expenditure. As a matter of fact, it means greater expenditure, but quality expenditure, targeted at areas where the linkages are. It's institutional reform, which Chidera talked about, the on-site reform. The institutional reform actually helps to reduce the linkages and makes the system of public sector management much more efficient. The private sector knows that if they don't do well, they will lose and they will go out of business. But the public sector doesn't go out of business. So that's where I'm coming from. That there should be a perspective, and it's not a binary choice. It's not either you do this or you do that. It is doing what you are doing in a better way, a much more efficient way, so that you can optimize the use of the resources that you have. That's my view.
Thank you, Mr. Ariwani. Dr. Adebaju, any comments here?
I think it's better for us to take another question. I think Bismarck has done justice to that question, so it's not repetitive. So maybe we should look for another question. Thank you.
Another question. Okay, great. If any of the panelists want to make any remarks other than that of Mr. Bismarck, you kindly indicate so that I can recognize you while we move on to the next question.
Yes, Dr. Fasher. The question was directed at me. The question was directed at me from the Kenyan lady, and I did answer.
Continue, Dr.
Online. Yes, I answered her online to say that I did mention the 6% to 3% cut in deficit, and I still maintain that rather than that, taking another shock therapy in that area, because we've taken a shock therapy on FX rate, management of FX is still a shock therapy. We could even extend that to some of the other subsidies. And like Dr. Teriba said, the issue is not subsidy. The issue is what are we subsidizing? I don't believe we should subsidize petroleum, okay? But, maybe somehow the big debate about what should we be subsidizing in the face of the fact that we are still a developing economy and very much still struggling economy, that one will take place later. In fact, I have the import and export profile of Nigeria in my head constantly. And the truth is that we have only two things that we export in the billions of dollars, which is the crude oil and gas. We got about $50 to $57 billion in that. However, only 30% of that is ours, according to the analysis from NAITI when Waziri Adio was there, 30%. So multiply that by 30%, we would hardly end up around 18 to 19 billion dollars. That is our own. And that's before we take account the expenses incurred by NNPC and the subsidiaries, which is huge. Okay, that's one. And so we have only that crude oil and gas and some urea fertilizer, which is about over $1 billion, $1.5 billion that we export every year. But on the flip side, we import about $25 billion worth of petroleum, whatever, all those things, that diesel and all of that, $25 billion. But not only that, abroad, we pay $1.5 billion for sugar. We pay for milk, another $1.5 billion for fish, about $2 billion that we spend every year for cars, about $3 to $4 billion that we spend every year for phones alone. In 2022, we spent $771 million. That's official. That's different from the phone that we buy when we travel abroad. So that's why I'm again talking about the need for that we also should see ourselves in all of this. It's easy. See, one of the reasons why I came here, and one of the questions you asked me in the ones you sent to me was, what do we do to grow, trust? The reason why Aweyemi called me to be here, and as someone in government who I know that I've faced a lot of barrage coming here today, but he said, look, let's come because we must continue to engage. We don't know it all. The beliefs we could do it this way, we could do it that way. All of these strategies are important. And I'm here to also learn and also to report to my principals, that, look, this is what's going on. So, but please, there's a need for us to begin to change our thinking in terms of some of the, I'm sorry, I want to take this as my last comment, our data, perhaps better. I was in the Dubai World Expo. I was one of the few Nigerians who managed to get into that World Expo that was done in 2021, which was rollover from 2020. The only thing that Nigeria had on display was its music. However, most of the money made from music in this country doesn't come to this country because the producers, all of our major musicians who sell out O2 in London and all of that, they've opened accounts abroad. Now there's a thinking around what is that. So anyhow, that's just basically it. I appreciate this platform and thank you very much.
Thank you very much, Dr. Fashua. Thank you. We appreciate your candor and presence. We have another question from Ismail Aliu, and I think the question is actually directed to Dr. Teriba, and he says, what is your assessment of the country's capacity to manage the impossible trinity effectively, and what would be your recommendations in that regard? So, Dr. Teriba, over to you on the impossible trinity and how we can manage it.
Okay, that brings us back to the issue that came out of that little exchange between me and Tilewa, that for you to see clearly, to manage monetary policy, you need to eliminate noise from either exchange rates or capital flows. That the impossible trinity is that you cannot have effective monetary policy, flexible exchange rates, and mobile capital, and capital flows are volatile. Your monetary policy will not be effective. So from the experience we have had in the foreign exchange market in the past 7, 8 months. It was just a good thing that Monetary Policy Committee never met since July. It would have been futile for them to meet. And they are planning to meet on Tuesday. If the exchange rate continues to behave the way it has behaved this week while they are at the meeting, if they meet on Monday and by the time they look at what the exchange rate has been on Monday, it has moved. And before they read their communique on Tuesday, it has moved. What do you want to announce on monetary policy rate? It's futile. Even if you take it to 100%, inflation will not come down. Because if exchange rate movement or capital flow will rubbish whatever it is you are doing. So you need priority. There is no debate. There are 3, the monetary policy components have hierarchies. So there are 3, levels. The first level is that you need to put your external sector at rest. So the 3 levels is, the foreign exchange, the fiscal, and monetary policy is only at the 3rd level. We talk about fiscal dominance. We are familiar with that, ways and means and the rest of that. So unless the country finds a way to stabilize the exchange rate market, and the way countries that have stable exchange rates have done it, is to build walls of reserves that are tall enough to absorb any volatility in capital flow. So reserve enables them to mute capital flow. And when capital flows are mute, it enables them to have stable exchange rates as though it's pegged, and it's not pegged. And then your monetary policy can be effective. If you raise your policy rate by 0.25 percentage points, it will be effective on inflation, it will be effective on growth. So Nigeria needs to do that. It's an emergency. It's something you have to just stop everything else you are doing and achieve within a month or 2. If you don't do that and you are trying to carry out with monetary policy, then you are living in a false world. The second one is fiscal stability. Fiscal issues are sovereign issues. There is no central bank in the world. The Federal Reserve Bank, that is perceived as the most independent, one of the most independent in the world. The Federal Reserve Act says that if any provision of this act conflicts with the Treasury Act prevails. So before you talk about monetary policy, you have to make sure that there's peace on the fiscal front. If a country has to prosecute war, you can't be talking about inflation targets. If national security is at stake, you can't be talking about monetary policy. So in a country that is fighting insurgency, that is, fighting kidnapping and the rest of that, let's make sure that our fiscal accounts are adequately funded. That's why we should be more than worried about the government. And once you can, have stability at the fiscal front, you are ready, to cruise on monetary policy. You are ready to begin to talk about monetary policy rates, and stabilizing the domestic liquidity. My view.
Thank you very much, Dr. Teriba. Dr. Adebajo, a question directed at you from Esther Madueke. With the size of the ways and means, can we stabilize the economy?
With the size of the ways and means, can we stabilize the economy? Yes, we can stabilize the economy. Like I said, there's a cause and effect. The ways and means, first of all, is illegal. And when you have something that is illegal, it's a question of how do you rectify that illegality. So, but the impact of that illegality is what we're feeling now. So, when we even talk about attracting investment into public assets or all those other things, the first of all is the fact that if you have 30 trillion naira that you have put out there, and most of that money has gone towards paying back your debt for your debt service, then it is counterproductive in the sense that you're spiraling inflation and you're increasing your money supply. What is the current money supply in Nigeria? Maybe about, 60 trillion naira. And you have one line accounting for close to about 50% of money supply. The total credit to the banks in Nigeria is about 40, 50 trillion. So you can imagine the size of that and the fact that all the CRR and all the things you are doing is stifling the Nigerian economy. And more importantly, you're crowding at the private sector because government borrowing is taking up most of the available capital, and that will have an impact on growth. Yeah, so I think the stability we need to achieve also, I think once you've done that, the first thing is to stop it, which they have done, which the government has done. They're now going to audit it and the Senate will probe it. So that's important to understand where those funds and formulation are there. And I think the MPC coming up should take care of that. Inflation should be under control, as I've said. I don't want to flog that issue. Rates need to go up by at least 700 basis points. It's called the yield curve in any economy, and that is what determines investments. If inflation is constantly above interest rates, especially for long-term funding, then your yield curve is negative and you're not going to attract investors because real returns and real yields are negative. And that is not good for any economy. And that is why you see there's a chase for dollars and people are chasing dollars for a store of value. For economic stability is not just the job of the central bank. The fiscal side has to come into line. Trade policy also has to come into line, and investment policy also has to come into line. So the alignment is not just monetary and fiscal policy, but trade policy needs to come into line. Investment policy needs to come into line. So yes, it is something that can be done. But again, we're talking about implementation of these reforms. As I've said, it's a marathon. It's not a sprint. But there's a desperate sense of urgency that is required at the moment.
Thank you very much. Dr. Oyebi Kale, somebody has asked a question, and it's about national data. How important is accurate data for trustworthy policies, trustworthy public policies? The problem I think the person is trying to, that's from Tayo, that with the data as it is, taking policies, it suggests that we have an unemployment rate of about 5%. And that suggests that since we don't have any problems with unemployment, I don't know how your response would be to this. To Odunaike's question.
I think we all understand the importance of data for planning, for policy introduction. I mean, it's very, very clear. With data basically is the eye of the policy maker. It's the one that determines, that lets you know what the current situation is, what's happening. Most of what we have said today from my fellow distinguished panelists, they have brought out a lot of data. Data is what is identifying the problem. It's also data that you're going to use to solve the problem. How do we solve an unemployment problem if we say we don't have unemployment? How do we solve an inflation problem if we don't track money supply, for example? So I think that question is kind of obvious, the importance of data, both for government to take policies, even for the private sector, even for development, for the private sector, for businesses to take decisions where the best location to put their businesses, where they know that their products will be patronized. Even development institutions, they have to know exactly where to intervene. It's all about data. So the importance of data is very, very clear. My views on unemployment, I think on the employment methodology, I think I've made that very clear. They are my opinion. I've said that I believe that the objective of data is to inform policy, not for international comparison. And even though international comparison is very important, and you can note that, but the objective of data is to inform policymakers. It gives them an indication of what your data to suit some methodology that might not be the best in terms of helping the policymaker. They are missing the point. It's not for chest beating. It's to inform policy to take accurate decisions. So you have to understand what is really going on in your economy. So I don't really want to go into too much debate on unemployment in data methodology is done, and I understand that it's largely political. The stronger countries in the world would push for methodology that suits their own narrative, and of course enforce that on all the other smaller countries, even though some of those methodologies might not be the best way for them to. I'll give you just one quick example. We're trying to check the quality of education. We're trying to get as many people to come to school as well to increase enrollment. So you're giving people checks, you're offering them breakfast and so on, just so they can enroll low. And that was a mismatch. So you have enrollment is at 80%, but literacy rate is very, very low. But then when you now checked, when we now check net attendance completion rates, you now found that it had dropped to about 40%. So yes, your policy, you should give checks to parents to bring their children to school to enroll, and a few months afterwards, they took their children out of school once the check dried up. So many of them are not completing. Now, it's already assumed that when a child is enrolled in school, is most likely going to finish. So they don't have to worry about that. So in their own system, enrollment and completion are almost guaranteed. But in Nigeria, it wasn't. So picking the right methodology, the right indicator, don't speak to the problem. You might just end up creating a situation. Just one more example, even with the poverty rates, you have the benchmark, the dollar, I think it's $1.90 now. Now you have a situation where you would say Nigeria's poverty rate is about, which will tell you that there's slight disruption in the economic activity, and you have a poverty rate of 70%. So it's extremely important, determine in terms of.
Thank you very much, Dr. Kale. And on the final note now, the final question from a member of the audience goes to Dr. Okiti. Dr. Okiti, Adamu Yusuf talks about, he asked, we address the confidence deficit with respect to government?
You have the tough programs, it's about initiatives. But I think to start with communication, I don't think there's been strong and credible communication about that paints a true picture of accident. So there is no communication of a true assessment and picture of where we are. That's number one. When we now have that, that gives people the sense of, okay, we are all in the crisis, which is what we all know anyway. However, coming from the president saying that makes more sense. Then the second kind of communication is, look, this is where we are. This is why we are here. This is where we are going to. And this is what this is what we are doing. Then this is what we expect will happen given what we are doing. So hope, then you don't give some kind of expectations about what people should really expect, given where we need to build credibility on the back of that communication. That credibility will come with your actions. And of course, it has to be consistent. It has to be credible, aligning your actions with what you say. So that has to be very, very credible. So for instance, we should be part of it, like the former president say, change starts with me. No, change does not start with me. That's nonsense talk. Whether it's leakages, whether it's corruption, whether it's the optics that does not look well, whether it's the harassment on Area 4 in Abuja or Sabo in Ibadan, those are measures. When you come up with actions that are credible, then people begin to believe in you. That is how you be credible, but it's not going to happen overnight. But I don't think we have seen credible measures from the fiscal side. And I think that's the only way we can start to build credibility.
Ask each of the panelists to give their closing thoughts. Mr. Riwani, could you kindly give your closing thoughts?
Well, I think that, again, like Oyinka Adewale said, that for this not to be another talk shop, there has to be specific understanding that nothing comes easy and that a mixed model is important. I've identified the fact that there's a difference between a stock postponing the crisis day. Therefore, you need to come up with new money. New money comes either to reissue some of the bonds to take care of your bond situation. I still believe that at the end of the day, you still have to talk to the multilaterals, new investors, new lenders will come in. And once the situation is stabilized and we begin to see a consistency, there's light at the end of the tunnel, please believe us that this is where we're going. And that brings me back to the credibility issue. So there's the ideological issue, there's a credibility issue with you as you go into this. This is not an easy journey at all. It's a difficult one, but life is tough. And when the going gets tough gets going. Thank you.
To give his closing thoughts, please.
Thank you very much. I think I agree with and I'm sure that this contributed and move along. But my own statement is very clear. Along the path from stagflation to growth, Nigerians in 2024, this will be accompanied by a high interest rate regime to tame inflation, combined with a scarcity of FX in FM with succor from the parallel market. During this period, it is important to constantly hedge to preserve value by moving excess liquidity and profits into assets that retain value. We had predicted that at the end of the year, the foreign exchange rate will be 1,800. Unfortunately, within a month of this prediction, the exchange rate is now 1,800. That means we're already in a crisis. There's no reason, there's no rhyme to this, and something needs to be done to stem this exchange rate system. So what we're also saying is that the current debt burden for Nigeria exceeds both recurrent and capital expenditure. Nigerian debt levels are clearly unsustainable and we're in a debt spiral. Add to this another 10 billion from the 2024 budget deficits. The question begs, is that Nigeria heading for default in the direction of Ghana, Zambia, and Ethiopia? This we must avoid. The discussion on restructuring for both domestic and London club imposition. We need to move and make a preemptive strike on restructuring our debt. While we believe that the fundamentals of the Nigerian economy remain sound, poor economic leadership has in the past failed to realize potential and grow the economy. With a new and highly rated economic management team in place, expectations are high. So the success or failure of our business projections and economy will depend on policies.
I don't know whether Dr. Fashwa is still around, still with us. Dr. Fashwa, if you're still with us. Okay, Dr. Fashwa has left. Dr. Okiti, your closing thoughts, please.
Yeah, thank you so very much. And I think I've thoroughly enjoyed the conversation here. And I think, largely, I think we are all speaking in the same direction. But I think my point is to reiterate the points I've been trying to make. We have to deal with macroeconomic because of what I see on the street, what I see around me. And the poor would not believe that I am not their problem. We will not believe that any of us is not their problem. So we need to deal with that macroeconomic instability at the moment. So I will deal with it. We already have said that's number one. Number two, I think after we deal with that, we have to do reforms. We have to do reforms, institutional, fiscal reforms, security reforms, land use. There are so many reforms to be done so that the economy can begin to produce and attract investment at the scale that will be optimal for this economy. I think that's very, very important. And once we do those reforms, we attract the investment, we make the progress. I think we'll begin to see there's huge potential in this economy, but we need to do the right things. And it starts with everything from the government side. I mean, they have to take the lead. The private sector will respond, but government will have to lead. That will be my closing remarks. Thank you so much.
Thank you very much, Dr. Okiti. Dr. Oyeyemi Kale, could we have your closing thoughts, please?
Okay, thank you. I think I'll just stick to the same theme of it's around everything that I've been saying. And first of all, I want to agree with Dr. Okiti's last statement, the importance of macro stability and it's linked to confidence. When you are bleeding, the first thing is always to stop that bleed, and that's just other things. And as long as you keep bleeding, how do you fix anything else? So I think creating macroeconomic stability, just stop the bleed first of all, before we can start thinking of what next to move into. I think that's my first point. Also, I want to also stick to my main argument, my main theme, which is basically the problem of harmonization, policy coherence, and coordination across government. Something that I've, in my time in government, and I've seen it still happen, has always remained a major challenge. That role of government, the role of government is to define the direction and introduce policies aligned to that direction. Then the public will buy in and then drive it. But where there is no coherence, or rather when there's coherence, you avoid misalignment. It helps to take into account all relevant synergies or relevant trade-offs, between all the different policy objectives, thereby designing the optimal policy mix across all policy or instruments. Until government gets this right, until we've talked, many of us on the panel have talked about different policies to introduce some for or against different positions. But then, if these policies are not harmonized and coordinated towards a common direction or goal, then at the end of the day, you're just going to fix one problem and create new one. So that harmonization, the policies to introduce is not, in my opinion, more important than ensuring the individual policies, whether it's fiscal or monetary, is not as important as ensuring that whichever policies introduced are introduced in a harmonized way across the entire macroeconomic. So that's exactly what's going to make it more effective. That's what's going to create that stability, and that's what's going to create that and build that, restore that confidence, which is very, very strong. We have to understand a lot of people have no confidence in Nigerian economy. That's a major problem. It's not necessarily that the policies are even wrong. There's just no confidence, no belief in it. Until you create that macroeconomic stability, stop the bleed, you're going to have that. You're going to have policies that are not as good policies that might not be as effective. Finally, just to relating to what Mr. Rewane had said in terms of the top 11, I'm not so. You look at the current economic team. There's nobody really with the grounding in macroeconomics that understands how the economic policy, how the macroeconomic functions. I think Dr. Fashua is probably the most grounded economist in the current list of advisors and ministers, and so that's a problem. And because that means the decisions have been taken without proper analysis, without proper studies, without rigor. But then that's not even the problem. Fine, you've put people, you have put what Mr. Rewane says is not the top 11 in the system. I don't even see that as a problem, as long as if a team, a technical team that understands the macroeconomy was created on the side and empowered with top economists, and there are many of them across the country who they take advice from. That can help in plugging the limitations in economics that the current 11 have. But you have two problems. You don't have that crack team to support you, and you don't have the necessary competence in macroeconomics from the team that is leading. So those two issues, I think, also need to be addressed. I think I'll just leave that. I'll just stop with those.
Thank you very much, Dr. Dr. Teriba. Your closing remarks.
Thank you very much, Mr. Moderator. And thank you very much, very distinguished panelists. I would also stay within the how do I now describe it? The frame of that has been provided us by Bismarck about the team, first 11. And Dr. Kale has already, started on the path in which I think we need to broaden the conversation. That you can have your first 11 on the pitch and they still won't win the match for you if they are not backed by a strong technical team, which is the point by Dr. Kale. Clubs invest heavily in acquiring coaches, and technical team to help the best 11s in the world so that they can deliver. That was a missing element in the Buhari regime, and is continuing to be a gap in the current regime. That not all of us have to wear jerseys, and have a number on our back. Dr. Fashua is not wearing a jersey. He's there as an advisor. He's not an executive. And I told Bismarck while they were on the Presidential Advisory Council, you're advising the president in secret that you should be issuing periodic reports of what advice you are giving the president, if not for anything else, but for public scrutiny and engagement. So you can have reference, the Council of Economic Advisors in the United States, presents the president's economic report that they defend in the Congress. So if you want to have a technical team together, let's know the advice they are giving. let's have it publicly debated, and then the team will benefit from it, the country will benefit from it. The other language that Bismarck has given us, which I also want to use in concluding now, is he spoke about flows and stocks. Our income flows are drying up. Our debt stocks are rising. And the only stock that is rising is our debt. Going to multilaterals only increases our debt stock. It does not increase our income flow. So while, borrowing is a way to escape from temporary income shortfalls, it becomes a trap in the face of permanent income shocks. The income shock we have faced has lasted 10 years and is not going to go away. So look for stocks that you will build. Build asset stocks. Find out the market value of your assets and grow their market value. Build equity stocks. Buhari regime never issued permanent income shocks. And so that's why we're saying issue equity to get out of the debt. So we shouldn't be afraid of debt default. Issue equity and use it to restructure your debt. Issue equity and use it to rejuvenate your income. And you see, when you say a stock of assets will be exhausted, I don't agree with you about exhausting stock of assets. LNG project was an asset, and the investments in the 6th train unlocked it. Is it going to dry up? When is it going to dry up? Telecoms was an asset that was idle. When is it going to dry up? So if you do rail, if you do power transmission, these are not assets that are going to dry up. These are, new growth opportunities, new employment opportunities, new revenue opportunities that will be enabled by attracting equity into assets. Thank you very much.
Thank you very much. Dr. Teriba, Economists Conference. Thank you very much, ladies and gentlemen.